Yeah, in this session, let's look at the valuation of equity securities using the dividend discount valuation model. Right? We all know one of the absolute models for valuing the stocks is the discounted cash flow model. Discounted cash flows. Now, what do we need to take as cash flows? So, from this dimension, we say there are three different kinds of proxies which we can use for the cash flow purpose. One is the dividend, that is what we are going to deal with in this session in full. But apart from dividend, we would also have a free cash flow which is used as a proxy to the cash flow. Or when I say discounted cash flow model, what is it that is used as cash flows? So we can talk about using dividend as a cash flow, because any equity investor, if he has invested in a security, the main cash flow that he is getting from the company for his investment is the dividend itself. So dividend can very well be used as a cash flow. Apart from that, we also have the scenarios where we can use free cash flow. We have defined it earlier and we will define it when required. Free cash flow is also an alternate to dividend for using it as a cash flow in the DCF model. And there is one more aspect called residual income. And when I talk about the dividends, all that is required is you project or you expect how much dividend could be paid by the company in the next few years. What is the expected dividend over the remaining life of the company? So that particular dividend we are estimating first using various mechanisms, and then discounting all those dividends to the present value to say that this is the worth of equity security. That's the simple dividend based valuation model. So, because this is very heavily dependent on dividends as the payouts, every company which has a good history of dividend payments, good and consistent history of dividend payments, can very well use this discounted dividend model for valuation purpose. And not just a good history of dividend, but the dividend policy is in line with the earnings. As the net income of the company is growing, probably the dividend is also growing. So probably it's like a constant or more or less constant kind of payout ratio is getting maintained. Means as the earnings are growing, the dividends are also growing. It's not ad hoc dividend, but there is some kind of a pattern with respect to the dividend that is getting declared. Even that, those kind of companies, it's worth evaluating their performance using the discounted dividend kind of a model. And because we are heavily dependent on dividend as the input, then dividend is generally decided by the management but distributed even to a very minority shareholder also. We say we can use this model quite effectively if the valuation is from the perspective of a minority or a small time investor. And to a large extent, what we observe is the companies which are declaring these dividends, they declare it more or less in a predefined constant pattern. So the earnings are much lesser volatile, which means even the valuation which we are doing using this mechanism may not be that heavily volatile kind of a scenario. So how do we do the valuation using the discounted dividend model and all? We'll go through in our next few slides. But just to understand the other two models also, a free cash flow based model. The way I can define the free cash flow is what is the cash that is available with the company after it has spent on all the operating expenses and even the capital expenses required to run the business. After incurring all these expenses, whatever is the cash that is left with the company, which can be distributed to its investors. Whether the company distributes it or not is immaterial here. What is the cash that the business has generated after all the expenses being removed? What can be used to be paid towards the investors? It could be debt investors or equity investors. But what is the cash that is available for payment to them? That is what we define as the free cash flow. So, wherever the dividends are not that consistent or ad hoc, or a company is not paying any kind of a dividend, in all these scenarios, we can very well resort to the free cash flow based valuation, because in a free cash flow it is really immaterial whether the company has paid a dividend or not. What really is coming into picture here is what is the company's potential, what is the cash that it has really generated to be paid to the investors. Whether it pays it or retains it, it is out of scope for us here. So that is what we are trying to look at when we are going for a free cash flow based model. So much better than a dividend based model, especially when the dividend history is not that good for the company. And this is also helpful when you are trying to do the valuation from the perspective of a controlling stakeholder, not a minority shareholder. It can help from the minority shareholders perspective also, but definitely a value addition when we are looking at it from a controlling stakeholders perspective, because as a simple thing, the controlling stakeholder can very well change the dividend policy. So you don't need to really go with the declared dividends or proposed dividends as the base for valuing the firm. So irrespective, so it is clearly working out on how much cash is available with the firm, and even for the future we are trying to project what would be the expected free cash flows for the firm, and based on that discounting all those free cash flows to the present value to say to compute the valuation of that particular equity security. The only drawback being if the company is generating a negative cash flows, especially in the initial years, especially for a capital intensive kind of a project, right? Initial years, capital intensive kind of projects, we may very well see that the cash flows are negative. So if there are continuously negative free cash flows, especially for the next few years, then it is not advised to go for a free cash flow approach. Otherwise, compared to a dividend discounting model kind of an approach, free cash flow is much more better, because the dividend policy is really immaterial in this case. So we'll have a detailed discussion regarding the free cash flow based valuation model slightly in our later sessions. Similarly, just to understand the third cash flow that is used as a part of the DCF models is the residual income based cash flow. Residual income is nothing but, see, we know the expectations of the investors. Let's say they are expecting a required rate of return of R, and they have invested some E amount, equity amount. So their expected return every year, what is their required return? Their percentage is R%, and they have invested E. So RE is the typical expected return of the investor. Now if the company has generated a net income which is greater than this, if the net income that the company has generated, the earnings the company has generated is greater than what is expected out of the investors, that is what we call as a residual income. So if the residual income is positive, it talks about a good image the company has built up. So probably resulting in the stock price going up and vice versa. So it is applicable even for those companies where negative free cash flows come up, because this the free cash flow can be negative, but in this case the net income is still positive. Right, there is a possibility of net income remaining positive while the free cash flow is negative. For a good performing firm, initial capital expenditure in the income statement, only the depreciation part of it goes in, whereas into the balance sheet, or whereas into the cash flow statement, the entire expense that is spent on the capital expenditure is going in. So from that standpoint, it is very much possible that the free cash flow can be negative, whereas the net income can be positive. So for those kind of firms, probably using residual income based model is much more appropriate than the dividend or free cash flow based models. So when we are not able to apply the dividend as well as the free cash flow kind of approaches, then it is better to look at the residual income based approach. But yes, this is heavily dependent on the income statement of the company, and income statement, as we know, is very much prone to tampering. So heavy estimates of the management and heavily dependent on how the management is transparent in terms of preparing these financial statements. It is very much reliable only when the quality of the financial statements is good enough, the quality of earnings is good enough. But if there is any possibility of any kind of tamperings possible on the income statement, then the residual income based model of valuation will be completely flawed. So in general, people use these three kinds of cash flows for valuing the firm using the discounted cash flow mechanism. And in this chapter, we would be focusing slightly into more detail on the dividend based discounting model for valuation of the security. And in the next couple of sessions, I would also cover in detail about the free cash flow based valuation as well as the residual income based valuations also. So getting into the dividend discount based model, whatever is the DCF model that is being used, the fundamentals are straightforward for us. Whenever I want to do a valuation, it is nothing but the present value of the future cash flows, right? Whatever may be the mechanism, present value of the future cash flows. So in this case, all we think of is a future cash flow is nothing but the future dividend. So whether we are holding that stock for 1 year, 2 years or 200 years, it doesn't matter. All I have to do using the DCF model is identify all the future dividends and discount them to the present value. That would give the value of the equity for that particular firm. So to whatever extent I am able to identify the dividend, let's take a couple of numericals, straightforward numericals. Expected dividend at the end of next year is 3. So 1 year from now. So which means this has to be discounted by 1 year. The required rate of return is 10%. Okay, so this has to be discounted for 1 year. Expected price at the end of the next year is 51. So even 51 is at the end of the next 1 year. So even as of today, if I want to find out, even I have to discount it by 1 year. So find the value of the share. So 54 divided by 1.1, whatever comes out is the value. So all I have to identify is the dividend, how much dividend is coming at what point in time, and probably if the share is getting sold off, at what price it is getting sold off, and at what time. discount all of them to the present value appropriately, that will give you the value of the stock. Now let's look at the next one. If it is expected that the above share is expected to pay a dividend of 7 at the end of year 2. Let me just take. So at the end of year 1, it will pay me 3. Year 2, it is expected to pay 7. And the price is expected to go to 73 at the end of second year. That is also at the end of second year. What is the expected value of the stock using the first year dividend and required rate of return, same as the above numerical. So this has to be discounted by 1 year. So it is divided by 1.1. So this cash flow 7 is coming at the end of 2 years. So discounted by 1.1 square. 73 is also at the end of 2 years. So discounted by 1.1 square. So the total value of the firm in this case is the summation of all the future cash flows discounted to the present value. So 68.84 is what is the value of the firm, value of the equity of the stock, value of the equity, if at all I am using this dividend based discounting model. And if the share is not sold in the middle, so this number will not be there, which means forever I have to forecast the dividends. If I am not selling off the shares, forever I have to think of the dividend and discount all those dividends to the present value. So as simple as that, nothing more than that, right? So that is the kind of simplicity that we need to understand as far as valuation of equity using the discounting of the dividend model is concerned. Think of all the possible future dividends, get them to the present value by discounting it with the required rate of return. As simple. Only if this one line you are able to understand, we can solve almost every kind of question that is present as a part of this valuation approach. Now on these lines, now we are moving on from selling off the share at the end of 1 year or 2 years kind of mechanism to holding the share for an indefinite period, assuming that the company is operating as a going concern. So as long as the company is existing, the shares are also existing, and we are not trying to sell off our shares in the middle, right? If that is the case, what are the dividends? Let me just give. Okay, I am expecting a D1 dividend at the end of first year, so I have to discount it to the present value. I am expecting D2 dividend at the end of second year, so this has to be discounted to the present value. A D3 dividend at the end of third year. So like that, I am expecting a DN dividend at the end of nth year. All these things I am discounting to the present value, and I am saying, or probably D infinite is the dividend that is coming in the infinite year. I am discounting it to the present value. The sum of all these things is what is the value of the equity in case I am not selling off the stock somewhere in the middle. Now we are trying to discuss some special cases of this equation. This equation, if you know, you can solve almost every valuation scenario as far as dividends are concerned. Now we are taking some special cases of this particular model, wherein we are saying, assume that the dividend is constant. First example, assume that the dividend is constant, means all years the dividend is going to be the same D. I am not saying constant growth, I am saying dividend is constant, means D1 equal to D2 equal to D3 equal to so on Dn. assume that every year constant dividend is being paid. Now I can alter the formula, d by 1 plus r plus d by 1 plus r squared plus so on d by 1 plus r to the power infinite. Now this is nothing but this is a geometric progression, applying a bit of mathematics here. This kind is a geometric progression wherein this is the first term and the ratio between the two is the common ratio. If I have to add up all these things, it is nothing but sum of infinite terms of a geometric progression which goes as the first term by the common ratio. So the first term is d by 1 plus r divided by the common ratio, which is the second term divided by first term, which comes out as 1 by 1 plus r. You see the first term a by 1 minus r, first term divided by 1 minus the common ratio. So this is what is the sum of infinite terms of a geometric progression. So it is working out as d by 1 plus r divided by 1 plus r minus 1 by 1 plus r. So obviously this is working out to d by r. D is nothing but that constant dividend, whatever is being declared as the constant dividend divided by the required rate of return. So that is what, if the dividend is constant, if at all the company is paying a constant dividend of D every year and the investors are expecting a rate of return of require a rate of return of R, the value of that particular stock is going to be D by R, means the company is not growing. It is giving a constant dividend, means it is generating a constant earnings. So no growth associated with the company. So the value of such kind of a company is simply the dividend divided by the required rate of return, D by R. So this is more or less like a constant dividend model, or sometimes this is used very heavily in case of preferred stock, where the dividend is constant for the entire period. Dividend is fixed and constant for the entire period in case of preferred stock, and the required rate of return of the preference shareholders can be known. So using these two things, we can very well find out what is the value of the preference stock as of today. Or any company which is not growing, both these scenarios, any company where growth opportunities do not exist, because if the company doesn't grow, the earnings doesn't grow. Earnings doesn't grow, the dividend doesn't grow. So any company which does not have appropriate growth opportunities, or when we are talking about preference stock, in both these cases we call that the dividend is more or less constant. So we use dividend by R, required rate of return, as the value of that particular security. So this is one kind of a model. Whereas the second model which I look at, the concept is still the same. The base is d1 by 1 plus r plus d2 by 1 plus r squared. Each of the year's dividends, I am trying to discount them to the present value using the required rate of return. Now the next thing that we are trying to talk of is, assume that the dividends are going to grow at a constant rate G. Assume that the dividends are going to grow at a constant rate G. So what will be the D1? What is the dividend that is going to be declared at the end of next year? So last year's dividend or current dividend, whatever has been declared, if I am thinking that it is D0, because it grows at G, I assume that it becomes D naught into 1 plus G after 1 year. So that I am discounting it right now. One more year later, because it has to grow at G, it becomes D naught into 1 plus G squared divided by 1 plus R squared. Similarly, D naught into 1 plus Z to the power infinite by 1 plus R to the power infinite. Even this is a resemblance of geometric. Why I am taking infinite here? I am making an assumption that the firm is a growing concern, and because it's a growing concern, the investment in that particular security will be there forever. So all I can do is, as long as my investment is existing, the dividend will come out. So based on that assumption, I am trying to go with the dividends that are going to come up, which are going to grow at the rate of G every year until the infinite period. Now this is also a geometric series. So first term by 1 minus R. So the first term D naught into 1 plus G by 1 plus R divided by 1 minus, what is the ratio between the two? 1 plus G by 1 plus R is the ratio. So simplifying it, it becomes D naught into 1 plus G by 1 plus R divided by 1 plus R minus 1 minus G by 1 plus R. So I can take these off, take these off. So the value of the firm is coming out as D naught into 1 plus G by R minus G. And of course, this is applicable, this formula A naught, it's the first term by 1 minus the common ratio, is applicable only when the common ratio is less than 1. So 1 plus G by 1 plus R should be less than 1. So 1 plus G should be less than 1 plus R. So this is applicable only when G is less than R. When the growth rate of the firm, continuous, constant growth rate. See, here we are talking about G as constant growth rate. When the constant growth rate of the firm is lesser than the investor's required rate of return, then I can use this model as the valuation model. So the valuation is D naught into 1 plus G by R minus G. Then D naught into 1 plus G is nothing but the next period's dividend. The expected dividend for the next period divided by R minus G. Right? So the small difference between a no growth model to a constant growth model. In a no growth model, we are taking D1 by R, whereas here we are taking D1 by R minus G, where G is the constant growth rate of the dividend payout. So, so this model, where the formula finally is coming out as the value of the firm is the next period dividend divided by R minus G. Sometimes people write it as the last current period dividend into 1 plus G by R minus G. Both of them remain one and the same. So as long as the dividends are growing at a constant rate for an indefinite period, I can very well use this kind of a model. So the basic assumptions which have gone in, the dividends are assumed to grow at a constant rate for an indefinite period. We have used those things. Dividends in line with the earnings, right? Generally, the payout ratios and all, they should be in line with the earnings. Payout is more or less constant, and the required rate of return R is greater than the long-term constant dividend growth. If it is lesser, I cannot use that geometric distribution, geometric progression formula of sum of infinite terms. So that's the reason that formula is applicable only when the growth rate is less than the required rate of return. So in general also, having this G, how do I get this G? There are various mechanisms to talk about this G, but this G is nothing but the long-term growth rate of the company. So, and the other way people try to identify that long-term growth rate is take it as a real GDP growth for the future plus inflation expectation. Expected inflation for the future. These two things put together is what needs to be considered as a part of the growth rate, and it cannot be more than the long-term GDP growth rate, right? Because in reality it is very difficult for a company to constantly exceed the real long-term GDP growth rate for an indefinite period. So the G is more from that dimension, though we talk about the various other mechanisms of calculating the G. So we are directly using the formula D1 divided by R minus G. If at all I am assuming right from the next period onwards, the dividends are going to grow at a constant rate G compared to the current dividend for an infinite period. Now this value, I generally break it into two parts. So let me take up a numerical that can give us an important analysis. Okay, compute. Okay, forget about PVGO and all that. Okay, current share price is 84 and an expected earning of 7 next year. Okay, so D1, if I am assuming that the next period D1 is going to be 7 by R minus G. Okay, so let's say D1, let's assume D1 is 7, R is 12%, and let's say G is 5%. If the firm is growing at the rate of 5%, then what is the value? 7 by 7%, which is making it 100. But if the growth is 0%, if the growth is 0%, then D1 by KE minus G is 0. So 7 by 12%. What is 7 by 12%? $58.3. See, if there is no growth in this firm, if there is no growth, if there is no growth in this firm, probably the stock is worth only $58. Which, if it has declared a dividend of 7 and there is no growth in the dividend for the next few years, whereas the required rate of return of the equity investors is 12%, the stock is worth only 58.3. But if I am assuming that the dividend is growing at the rate of 5% every year, then the same stock it is going to a worth of $100. So whenever we are talking about the current price, okay, if it has to be 84, if the worth of the stock has to be 84, then what is it? D by K naught R minus G. So 12% minus G equal to 7 by 84. So it is becoming 12% minus 7 by 84. So this is coming out to around 3.67%. So 3.67%, if the dividend is growing at a constant rate of 3.67%, then it is generating a value of 84. Now the current value of 84 is composed of two things. In case there was no growth, it was worth only 58.3, whereas the remaining 25.7 extra, that is making the value of it as 84. That excess 25.7 is what we call as the present value of the growth opportunities for the firm. So any value that we are deriving, we are attributing it to two major aspects. One is as per the current dividend or as per the current earnings, what is the growth of what is the value of the firm, and in case the company is growing at a particular rate, what is the value of the firm. So these two things put together will give me the total value of the firm. So that excess is what is contributing to the present value of the growth opportunities. And if that firm is growing quite drastically, we see that this number is quite significant in the value. But if the firm is growing at a much slower rate, here the firm is growing only at 3.67%. But if the firm is growing at, let's say, 8% or 10% in the long term, then probably the contribution of present value of the growth opportunities is much more higher. So every firm needs to be evaluated as a breakup between the value of the current earnings. If it continues to earn at least this much what it has earned right now, if it continues to earn at the same rate in the future, what is going to be the value of the security. But if it is expected to grow at certain rate in future, what is the excess that gets added up to the value of the firm, which is contributing to the present value of the growth opportunities. We see that it is much higher for a heavy growing company, whereas for a slow stable growth kind of a company, that number is much lesser. And what we can also see is we can even find out the implied growth rate by equating the model value to the market price. So probably here, compute the implied growth rate. If the current stock price is 200, so take this as the value of the firm itself, assuming that the current stock price is same as the value of the firm. You can find out the implied growth rate, D1 by R minus G. Dividend, it has declared a dividend of 10 recently. So in the next period, the dividend is going to be 10 into 1 plus G. You have to be careful about D1, next period dividend, by R minus G, 8% minus G. Right? This is what is the formula here. So 200 equal to 10 into 1 plus G by 8% minus G. So which is making it 16 minus 200G is equal to 10 plus 10G. So directly making it 210G is equal to 16 minus 10, 6. So G is coming out as 6 divided by 210. So the G is working out to 2.85%. The G is working out to 2.86%. So that is the implied growth rate in this particular process. Right? So we can compute the implied growth rate by equating the model value to the current market price. And once I know the current market price, I can also break out between what is the value of the current earnings and what is the value of the growth opportunities that are existing with the firm. So these are some of the basic calculations that we can do using the Gordon growth model, which initially stresses that right from the next period onwards, the dividends are planned to grow at a constant rate for an indefinite period. But in reality, sometimes Probably for the next few years, the dividend can grow at a different rate, but after that, they may grow at a constant rate. So all those kind of reality pictures will come into picture, but this particular model very clearly assumes that the dividends are planned to grow at a constant rate from the next period onwards forever, right? So the next aspect which we would look at in the same context is, even this model helps me to understand what should be the P by E multiple for this particular security. What should be the, I am not saying what is, what should be the P by E multiple for this security from the understanding of the fundamentals of this particular company. See, what we are getting is what should be the price, right? When we used value d1 by k, d1 by r minus z, this is value, which means what should be the price as of today, right? So when I divide this price by earnings, that is what I get as P by E ratio. So the same thing, when I am dividing by the earnings, I get D by E, P by E ratio. But yes, if I am taking the past earnings, I call it as trailing P by E ratio. If I take the next period earnings, I take it as leading P by E ratio. That's the only thing. And the P by E that is computed from, not from the market price, but from the valuation price. The P by E that is computed from the valuation price, we call it as justified P by E, because what should be the P by E ratio. It is not what is as per the market. So that's where we use the word as justified P by E ratio, depending on whether I am using the past earnings or the future earnings. I will call it as trailing P by E or leading P by E. So an interesting aspect that comes out here, let's say I am using leading P by E. So d1 by r minus z divided by e1. A small arrangement will make it d1 by e1 divided by r minus z. And d1 by e1 is nothing but payout ratio. The next period dividend as a percentage of next period proposed earnings. Payout ratio by R minus Z is what is the leading P by E. So when I am saying payout ratio, generally we use a symbol called B for the retention ratio. So payout ratio means 1 minus retention ratio. So that's where we wrote it as 1 minus B by R minus Z. B is an indicator of the retention ratio. As the terminology wise, B represents the retention ratio. So because we got the formula as payout ratio divided by R minus Z, which is nothing but 1 minus retention ratio divided by R minus Z. The same thing if I am going for trailing, P naught is D1 by R minus Z divided by E naught, which is the historical earning. D1 I can write it as D naught into 1 plus Z, because we are going with the Gordon model. E naught into R minus Z. So D naught by E naught again is the payout ratio, historical payout ratio. 1 minus retention ratio historically means the last period into 1 plus Z by R minus Z. That is what will come out as the trailing P by E ratio. So we have to really understand what should be the P by E ratio for this kind of security, rather than looking at from the market what is the P by E, because the P there comes from the market, not from the value of the security. Now let's look at finding out a small numerical on this. Find the leading and the trailing P by E for a stock currently trading at 128 bucks earning. E is $33 a share and paid a dividend of $11 per share. Dividends are expected to grow at 3% continuously forever. And so the growth rate is 3% forever, and you assume that R is 9%. So when I want leading P by E, I can go for D1 by E1. So the payout ratio will still be the same. The payout ratio in this case is 11 by 33, which is 1 by 3. So B will go as 2 by 3, the retention ratio. So if I want leading P by E, I can take it as 1 minus B, which is 1 by 3 divided by R minus G. 9% minus 3%, which is 6%. So 1 by 3 into 6% is what is my leading P by E. Whereas if I want to go with the trailing P by E, this I multiply with 1 plus G, so which is into 1.03. Rest all is the same, right? Rest all is going to be the same. So 1 by 3 into 18% into 1.03 will become my trailing P by E. So the calculation of leading and trailing P by E needs to be comfortable, and based on this only we can even get into the valuation process or even evaluation process of whether the stock is overpriced or underpriced kind of decision. So the P by E also plays an important role as a part of our evaluating the performance of the stock. So this is how we compute our justified leading as well. These are justified because they are coming from the value of the securities, not from the market price. This is one thing that needs to be understood from this concept. Now that we have looked at the Gordon growth model, we are just summarizing that aspect, saying this model is good for companies which are already in their stable state, maturity phase, where from here onwards we assume that the dividends are going to grow constantly forever, generally applicable for indices. We can use dividend discounting model because from that stage onwards I see that the company is going to grow at a constant rate of dividend forever. So easy to explain, and it can be clubbed with other valuations. We'll see from in the next slide onwards, probably a 2-stage model, 3-stage model. Towards the end, all these models are using the Gordon growth model only internally. So it can be clubbed with other models quite comfortably, and at the end the formula value equal to D1 by KR minus G. Now there are 4 variables in it. By knowing 3 variables, I should be able to compute the 4th one quite comfortably. So it can help me either in computing the required rate of return or the constant growth rate, or what should be the dividend. All these kind of things can easily be computed once we have this particular formula in place. But of course here we have to be careful that the whole formula is heavily dependent on R and G. Getting accurate estimates of R and G is a very tough task. So even if there is a small change, probably 1% difference between R and G, it can have a big impact on the value of the particular stock. So we have to be slightly more careful in terms of determining R and G. Though the formula is easy to compute, arriving at the values that are going into this formula is a very tough job, right? If I am assuming R as 12% and G is 5% versus 6%, it will have a huge difference in the value of the firm. So that is one reason unless we have taken utmost care in finding out the input variables, it is not suggested to go for usage of garden growth model. And of course, as we have already discussed, this model is not applicable for stocks which don't pay dividend, or even if their growth is much higher compared to required rate of return, because it makes an assumption that G is less than R. Wherever those stocks are existing whose G is much greater than R, probably it is not advised to go ahead with this kind of a model. Alright. So now let's get into the next set of models, which are improvements over the garden growth model, because the garden growth model is straightforwardly assuming that from the next period onwards the growth is going to be constant for infinite period. But in reality, we may observe that depending on where the company is in the industry life cycle, it may grow extraordinarily for the next few years and after that stabilize in its growth. So it is not expected that it will grow at a constant rate from the next period onwards itself. So for those kind of firms, you cannot directly use the garden growth model. So we are trying to bring in a little bit of more improvisations using the 2-stage, 3-stage H model kind of models to evaluate those kind of securities. So looking at the multi-stage growth models, especially for companies which are operating at different stages of industry life cycle, looking at the multi-growth models is an interesting aspect, because these companies can exhibit different growth rates for different periods before stable down. Before they stable down to a long-term growth rate, probably the long-term growth rate may come probably after 10 years, but within this 10 years they may follow different growth rates. Probably the next 5 years superficial growth, after that slightly slowing down in the growth, but after 10 years probably settling down to a long-term growth rate. All these kind of things are very much possible. So whenever we use the word long-term growth rate, we are looking at it as long-term real GDP growth plus expected inflation during the period. So depending on how many such growth rates are there, we call them by their names: 2-stage, 3-stage, H model. We differentiate them depending on the number of stages of growth they exhibit. Let's say for the next few years it grows at, let's say the dividends are going to grow at 10%, let's say for next 5 years, and after that the dividends are going to stable out to a long-term growth rate of 5%. This is 2-stage growth model because we are talking about 2 different stages. This is a 2-stage growth model. Similarly, if I am saying 10% for 5 years, another let's say 8% for another 3 years, and after that a stable 5%. There are 3 stages, so that is why we call it as a 3-stage growth model. Otherwise, 10% for 5 years. After that, there is a gradual fall over the next 5 years to 5%, means probably 9% in the next year, 8 in the next, 7 in the next, something like that. It is coming down to 5% over a 5-year period, and after that it is stabling out. This kind of a model, we call it as a H model. So instead of a drastic fall from the last year to the current year, we see a gradual fall linearly down and finally converging to a long-term growth rate. So all these kind of models are very much possible. But what we are seeing is, from whatever period we are talking about a constant long-term growth rate, from that point onwards, the value we generally find the value at that point, from wherever there is a constant growth for an infinite period, we try to find out the value at that point using the Gordon growth model, which means in most of the exercises we come across the Gordon growth model, right? But the value is not found as of today, but it is found as of that future date from where we see the growth to be more or less constant. And of course, once I know the value as of this date, I can find the value as of today by discounting it with the required rate of return itself. So all these multi-stage models at some point or the other, they take the help of a Gordon growth model to decide what we call as the terminal value. That's the typical name we use, terminal value. Typically the value after our forecasting period, from where I am assuming that the growth is more or less uniform over a long term infinite period. That particular value is what we are calling as a terminal value. In most of the cases, people find terminal value using the Gordon growth model itself, but in some cases we use the price multiples, a P by E kind of a ratio, to identify what should be the terminal value at that point. We'll come back to that. But a multi-stage model is an extension to your Gordon growth model itself, except that initial few years the growth rates are different. They are not constant as identified by the Gordon growth model. They are different at different points in time. Only after a certain point in time only the growth is assumed to be a constant scenario. Let me take a couple of examples that make things more and more easier. Right, once I look at this particular example, probably things will become more and more clear for you. Okay, the current EPS is $4. Okay, let me put it. The current EPS, earnings per share, currently I am putting it as 4. Expected EPS growth for the next 6 years, 2.8% per year. Okay, so the next year EPS, I am expecting it at a growth of 2.8%. So it is going to grow to this level, second, third, fourth, fifth and sixth. So these are the expected EPSs over the next 6 years. Fair enough. A dividend payout every year. Okay, here let me take, instead of 10 years, let me take it as 6 years across. Dividend payout every year for the next 6 years is 60%. So because these are the EPS, 60% of this is being taken as the dividend per share for each of the next 6 years. Fair enough. Current stock price is 60. Current market price is $60. Expected, okay, let me talk only in terms of the required rate of return is 6%. Okay, the R, the required rate of return is 6%. Now, from there onwards, at the end of 6th year onwards, we are assuming okay, here I need to find out at what rate. Here also I need to have an information that after 6 years, right, after 6 years, I want to know that the stock is, the company is going to grow at a constant rate of dividend. Right now it is growing at 2.8% every year. But after 6 years, it has to grow at a different rate. That is when I can use a two-stage model. Okay, after 6 years, let me assume that it is going to grow at 2% forever. So, which means from this year onwards, the dividend is going to be increasing at the rate of 2% forever. So, this is a constant growth. So, because this is a constant growth, I can find out the present value of all these things. The present value of all these things using the Gordon growth model. D1 divided by R minus G, 6% minus 2%. So it is coming out that 72. All these things is coming out as 72. And these are the different dividends for the next 6 years. So each one of them I have to discount them to the present value, D1 by 1 plus R. Similarly, D by 1 plus R squared, this dividend by 1 plus R cube, 1 plus R to the power 4. Otherwise, I can directly use the NPV kind of a scenario, wherein I'll take the first year's cash flow as something like this, except for the last 6th year, where I take the 6th year's cash flow separately, and also from 7th year onwards till infinite period, whatever are the cash flows that have come out. So this is the value at the end of the 6th year. Now I can use the NPV based on 6% interest rate and saying these are the cash flows. I am going to arrive at the value of the firm, saying right now the value of the firm is going to be somewhere around $63.87. If at all I am assuming that the current EPS is $4 and I am expecting that it will grow at the rate of 2.8% for the next 6 years, and after that at the rate of 2% per year for an infinite period, right? If I am going with that kind of an assumption, I can directly find out from the 7th year onwards, there is a constant growth of 2% for infinite. So because from the 7th year there is a constant growth, D1 by KE minus G. So I am finding the value at the end of the 6th year by taking the 7th year dividend, the next period dividend by R minus G. So at the end of the 6th year, the value will be the 7th year's dividend by R minus G. So based on that, we got some value, and for the first 6 years, different dividends are being declared. Find out the present value of all those dividends using the NPV kind of an approach to finally come out with saying this is the value of the security using the 2-stage discounting model. The same way you can use 3-stage or even H kind of a model to finally find out the value of the security. Right? If I assume that, okay, probably let me take a simple example. Let's say the first year dividend is $10. Right now, the 0th year, the last declared dividend is $10. For the next 3 years, I am assuming that the dividend is expected to grow at 10% per year. Okay, the dividend is expected to grow at 10% per year, so it is becoming 11 at the end of the next year and probably 13.31 at the end of 3 years. After that, I am assuming that the dividend is going to gradually come down. For 3 years, it is at the rate of 10%. It is growing at the rate of 10%. And after that, probably for the next 3 years or next 3 years, I am assuming that the dividend is going to come down by 1% every year. This is the H model. I am assuming that the dividend growth is going to come down by 1% every year, and probably from the 7th year onwards it is going to go at grow at a stable rate of 6%. So over 4 years there is a constant drop. So which means if I have to see this dividend would have been this into 1.09, whereas this dividend would have been this into 1.08. Here it would have been this into 1.07, and from here onwards there is a constant growth of 6%. Right, from this period onwards for infinite I am saying a constant growth of 6%. So from wherever I am assuming a constant growth of 6%. So because from the 7th year I am assuming a constant infinite growth of 6%, I will find the value at the end of 6th year. Next period dividend divided by R minus G. Okay, the next period dividend is what? This into 1.06. This is the next period dividend. So as of this period, what is the value? Next period dividend divided by R, let me assume as 10%, minus G, which is the long term average growth rate. So 444 is the value that is going to come up. So when I have to find out the value of the share, so basically each period dividend, take it as it is in your NPV formula. Only for the last period, along with the dividend of that period, the present value of all the future dividends as of that, because the growth rate is constant as of that date, add them up and take this is the value. Then you can compute the NPV by taking 10% as the required rate of return and then finding out the present value of all of them, working out to $309. So the present value of all these kind of dividends is going to be $309.89, which is saying the value of this share should be somewhere around $309.89, especially if it is expected that for the next 3 years the dividends are going to grow at 10%. After that, over a next 4-year period, they are constantly going to come down gradually, linearly to 6%, and after that stable out at 6%. So when such kind of scenario is being used, it's better that you take step by step, compute the dividend at each of the step, then use the NPV to find out the present value, and even wherever the terminal value is required, you can very well use the Gordon growth model to find the terminal value in that case. So it is more flexible. Even any kind of growth period can quite comfortably be accommodated into the model, and once you have a spreadsheet with you, you can try to play around with the dividends, the growth rates, create sensitivity analysis, and all these workouts can very comfortably be done before arriving at the value of that particular equity security. So how well you give the inputs, it is completely up to the analyst. The better the analyst is giving the inputs, the worthy are the values that are getting determined. So there is a lot of sensitivity in terms of the values that are being used. A small change in the values is going to impact the value of the stock quite effectively, heavily, because the terminal value, if we see here, the terminal value is a real big number. A small change either in R or G is going to impact the terminal value very badly. So enough care has to be taken in terms of working out on those aspects. And as I have been talking earlier, the Gordon growth model is applicable for firms which are generally operating in their maturity phase, where the earnings are growing but at a stable rate, the dividends are paid at a stable rate, right? Not too much of aggression exists. So the intention is more and more to consolidate and even maintain the stable growth forever, no aggressive growth at any point. So even the dividend payouts are stable. That is the scenario where you can see the required rate of return, what the investors are expecting will be the same as what the company has generated as return on equity. So in this case, a garden growth model is quite comfortable to be used. But when we see companies which are more and more in the initial growth phases, where generally the dividends are very less because the company wants to reinvest, retained earnings are much higher in the initial phases because the focus is more on growth and market share and all these aspects. There is very little of competition, so the earnings they grow very rapidly, but the dividends are not growing in proportion to the earnings. So in that case, it's not that advisable to directly go with a garden growth model there. So in that case, it's better to use a 3-stage model or a H model kind of scenarios rather than using a garden growth kind of a model, because in this scenario we always see that the company's profits, because the net income is very high, the return on equity is generally much greater than the investors' expectations. So for this kind of a scenario, wherever we find this kind of a scenario, it's better to go with a 3-stage model or an H model rather than directly applying a garden growth kind of a model. And especially in the initial stages of the business, we see that the capital investments are very high, so free cash flow to the firm will generally be negative. So there is no point in using the free cash flow model there. It's better to go with the dividend based model itself, but going at a 3-stage scenario. Similarly, if the firm is more into a transition phase, the earnings are still growing but at a decreasing rate, competition starts entering into the business, the ROE will still be higher than R but not that high as it was in the case of initial growth phase. The FCFE will start turning positive and start growing. In this case, whenever we are seeing in a transition kind of a phase, it has moved away from the initial growth phase. Now in a kind of a transition phase, it's better that you look out for a 2-stage model rather than a 3-stage or a direct garden growth kind of a model. So depending on the industry life cycle or in which phase is the company operating with respect to the industry life cycle, accordingly we can look at the choice of the phases. Accordingly we can look at the choice of the valuation model based on the dividend. And just now we have looked at how do we compute the terminal value. One way to compute the terminal value was using a garden growth model itself, assuming whatever is the dividend of the next period, assuming at what rate it is going to grow up. D1 divided by R minus G will give me the terminal value at the end of the period. Sometimes people also depend on the price multiple. They project what will be the P by E ratio at that particular point in time. What would be the earnings per share at that particular point in time. Multiply these two things to finally arrive at what should be the terminal value at that point in time. Straightforward. So here, probably if I am going with that same approach, the current stock price is 60, fair enough. So which means what is the current P by E? 60 by 4. Current P by E is 15, fair enough. Now expected P by E at the end of 6 years. So the analyst is forecasting that the P by E will grow by 30% during this period. So P by E will touch 15 into 1.3, which will make it 19.5. So P by E at that point is going to be 19.5. And earnings, earnings at the end of 6 years we have already decided, right? We have already worked on, these are the earnings at the end of 6 years. So what we can do is P by E 19.5 into EPS at that point in time, saying in that case take the terminal value as 92.05. Whereas when we have used the dividend discount model, the terminal value has come out as 72. But when when I've used the Gordon model, we got the terminal value as 72.22, but when I have used the price multiple, I got the terminal value as 92.05. So either of the mechanisms can be used to arrive at a terminal value, and based on the terminal value we can very well work out what should be the based on the P by E multiple, we can automatically work out what should be the terminal value at that point. Use that terminal value, discount it to the present value, and say this is the value of the equity security using the dividend discounting model. So now even these models can very well be used to compute the return. As I said, as per the Gordon model, value is equal to d1 by r minus g. So if I want to find out r minus g equal to d1 by v and r equal to d1 by v plus g. In this case, v is nothing but value which is equated to the current price, which should be the same as the current price if the model is working out correctly. So R, the required rate of return, in this case I can work it out as d1 by p naught plus g. The same way, if I am using a H model or a 2-stage model, 3-stage model, it's not worth remembering all these formulas and all. Probably you can play around with, okay, what if the R is 10%, 12%, you can just play around with the numbers, which can give you what is the growth rate implied in each of them, or it could also give you what is the required rate of return for this entire period. So which is nothing but it is a simple algebraic derivation of R using this entire process. Rather than trying to remember the formula, a small trial and error approach can also give you a much better and easier way of computing the required rate of return. But one thing we have to be comfortable here is this dividend discounting models help us in even deriving what is the required rate of return in each of the cases. So spreadsheets, more and more flexible, more and more computational, they can help you in terms of working out with accuracy, in terms of playing around by creating various financial models, and also allow you to do all kinds of sensitivities and scenario analysis and play around with what if what if analysis scenarios by changing either R or G or any of those parameters used for determining the value. One more concept that is worth knowing as a part of this process is the definition of sustainable growth rate. The growth rate G which we have been using, there is a definition of sustainable growth rate which says what is the rate at which your earnings can grow if the capital structure is unchanged and no equity is issued. So no new equity is issued means even if the D is even if the E is growing because of the retained earnings, the D is also growing accordingly. So debt to equity ratio is more or less constant. If that is the case, at what rate can your net income grow? The rate at which the net income can grow is what we call as a sustainable growth rate. Generally, it is looked at from the perspective of return on equity times the retention rate. That is what is a measure of the sustainable growth rate, and return on equity is purely coming from your DuPont analysis. Net income divided by sales into sales by asset turnover, total assets divided by equity. This is what is your return on equity coming from the DuPont model multiplied by 1 minus the payout ratio. Now net income by sales profitability margin, net profit margin, which is the profitability ratio, asset turnover ratio, and financial leverage multiplied by retention ratio. All these things put together is contributing to the sustainable growth rate of the company. And whenever I am taking this total assets or total equity, we are looking at the beginning of the period balance sheet values to compute this sustainable growth rate, which can be very well used for the long term growth or the current growth rate, especially if the growth rate is more and more fluctuating. I can use this formula to obtain the sustainable growth rate of the firm, and then if it is very heavy compared to the long term GDP growth rate, then probably I may think of using a 2-stage or a 3-stage model to arrive at the valuation for the firm. So in general, we are using the sustainable growth rate using this particular approach. So, and once your model, whatever may be the model, garden growth, 2-stage, 3-stage, whatever may be the model we have used, if the model price is less than the market price is much higher. If I compare the model price with the market price, if the market price is higher, I say that the stock is overvalued. Market price is lesser, I say it is undervalued, which means a buy decision. Overvalued is a sell decision, and market price comes closer to the model price, then we say that this particular security is fair valued. Right? So this is how we use the dividend discounting model to evaluate the worth of an equity security. If you have any clarifications required on this aspect, you can very well get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.